How's it going, everybody? It is me, Mr. Drake, back from holiday, and today we're discussing the car finance boom of the last decade. We're going to talk about why I chose to buy a car on finance 3 years ago. We're going to discuss why I'm choosing not to get another car on finance now that my current deal's coming to an end. And we're going to talk about how car financing could affect your future wealth. But I want to keep it really simple today because there's a number of ways car financing could rob you of your future wealth, and I want to try and help you steer around those obstacles. So engines are ready, let's go. I recently read a statistic which led to the filming of today's video. It said that close to 80% of new and used car purchases were made using car finance agreements. Now, while car financing can help many people get the car that they need when they're in a desperate situation, for the most part, what it allows people to do is buy a car far beyond their means just to keep up appearances. One of the first commercial cars ever made was the Model T in 1908. It cost roughly £300, equivalent to about £19,000 in today's money. This meant that many people who wanted to own a Model T would have had to save years to afford it. General Motors saw an opportunity in this, and they created the General Motors Acceptance Company in 1919. This allowed prospective buyers to pay for their car in monthly installments instead of paying in one-off upfront cash sum. Ford were the next company to do this in the 1920s, and many other companies followed suit in the years to come. While car finance agreements have changed since 1919, the concept still remains the same. All you need to put yourself behind the wheel of a new or used vehicle is a small upfront deposit, and in the instance of my personal finance agreement, not much else. But the official line is you need a regular income and a not terrible credit rating. In July 2016, my smart car met its end, and to be honest, I was lucky to get £50 for it from We Buy Any Car. At this point in my life, I was not only cash flow poor, but I was in over £7,000 worth of debt, and I was earning less than £800 a month as a personal trainer. I had no business buying a car at this point in my life. The last thing that I needed financially was another expense dragging me further into debt. But that didn't stop me, and nor did a credit check. So I walked out £500 worse off, with more monthly obligations to try and cover. But I did get a brand new car. To this day, I still don't know how I cleared the credit check, but all that I can imagine that it came down to was the fact that the finance agreement that I signed was a secured debt. Secured debts mean that the money you borrow is contractually linked to another item. For example, when you take out a mortgage, the money is contractually linked to the house that you're purchasing. With a car finance agreement, the secured debt means that if you fail to make a repayment, the company can keep the money that you've paid previously and take the car back from you. The reason they're able to do this is because the car finance company doesn't lend you the money to buy the car for yourself. They buy the car for you and you repay them. So until you have cleared the contract, you only own a percentage of the vehicle and the finance company owns the rest. It was for this reason that the finance company didn't feel too uncomfortable about entering into an agreement with me, because they knew that as long as I didn't default within the first year, they would make a profit either way. Before entering into a finance agreement, there's a few things that you need to find out that will tell you a lot about the terms that you could be agreeing to. The first one is the total cost of the car that you want to buy. The second one is the total cost of the finance agreement. The third one is the length of the agreement. The fourth one is the type of finance agreement. The fifth one is the optional final payment value. And the sixth one is the interest rate. Now let's look at these in a bit more detail. I don't see how anybody could buy a car on a finance agreement for the same cost that they could have bought the car upfront in cash. This is because the lender needs to make a return on the money that they've lent, and they may also have borrowed that money from somewhere else, so they have their own interest rates to pay on that money too. Before you sign up to any finance agreement, it will show you the total cost of that agreement, and it's basically made up of your initial deposit, your monthly direct debits, and your final optional payment value. You want to keep the cost of the car as close to the total cost of the finance agreement as you can to avoid massively overpaying for the pleasure of owing someone money. The obvious temptation with a finance agreement, whether it's for a car, a sofa, or even a house, is to keep the monthly payments as low as possible. This can be done two main ways. The first is to buy a cheaper car. The second is to stretch the contract length. Most people will pick option B, and some people will pick option B. They'll stretch the contract length so their monthly payments are lower, But then they'll realise, actually, I can spend a bit more, so they buy an even more expensive car, paying even more per month for an even longer period of time. If you're buying on finance and want to keep the total costs as low as possible, keep the contract length as short as possible. This is because the longer your contract length gets, the less of your monthly direct debit will go towards paying off the car, and more will go towards paying off the interest. To give you an example, you buy a used Ford Focus for £7,500 on a 7% base rate finance agreement with a £500 deposit. The total cost of your finance agreement would be roughly £7,522 or £313 a month over 2 years, £7,781 or £216 per month over 3 years, or £8,046 or £168 a month over 4 years. So from this, as you can see, as your contract got longer, your monthly expense got lower, but your total expenses became a lot higher. It's for this reason that we want to keep our contracts as short as we can afford to. Let's now take a look at how a finance contract could make an expensive car seem affordable. On a 4-year contract, I could easily afford to purchase this 3-litre Audi S5 Quattro on the finance plan you see in front of you. However, that's a £35,000 car, and at my current rate of saving, it would take me about 3 years to afford it, using 100% of my savings. That alone tells me that I cannot and should not agree to a contract on that car, despite it being comfortably affordable on a monthly basis. There are 2 main types of finance agreement, and they're very similar, but they have one major variable that changes between the two. They both rely on you making an initial deposit and making regular monthly payments towards the purchase of the car. The big difference between them is that with a hire purchase, when you've made your deposit and your contract is finished, you've made your payments, you own 100% of the vehicle, it is yours outright. With a personal contract purchase, or a PCP, you have 3 options at the end of your contract. You can either give the car back and walk away, you can give the car back and start a new finance plan with a new vehicle, or you can make what's called the final optional payment, or the balloon payment, at the end of your contract, and that will then allow you to own the car outright. Hire purchase agreements work out more expensive per month, but that is because you don't have that hefty price tag waiting for you at the end of the contract. I bought my car with a PCP agreement because at the time I was very broke and very desperate. I got the cheapest possible car that I could buy from new with only £800 of additional extras, and I arranged the contract to make the monthly payments as cheap as I could. This meant that I pushed a lot of the value and the cost of the contract towards the back end, which I'm having to pay for now. My eagerness to make it as cheap as I could means that my final balloon payment is equal to about a third of the car's original value, and it's equal to about 60% of the car's current value. The phrase optional final payment is the key to success of the automotive finance industry. This is because it relies on forcing customers to stay on the finance treadmill year after year. In the example of my car, every fibre of my body is screaming at me, telling me not to buy my car up front now, but in fact to start a new finance agreement with a new car, because that will only be a couple of £100 a month as opposed to the thousands that I'm going to have to spend now to get off of the finance treadmill. Now, I lied to you earlier on. I said there was only 2 ways that you could reduce the total cost of your finance agreement. There was actually 3, but I didn't want any spoilers. The third thing that you can do is make the optional final payment as low as you can afford to. Here's an example, again using the Audi S5 Quattro from earlier. First, you can see the cheaper monthly option is the PCP over 3 years at £625 a month. Notice the final payment is £18,986, just shy of 19 grand. When we look at the hire purchase, you can see the same car, deposit and contract length costs about £450 a month more. However, there is no final payment of 19 grand, and you end up paying less in total by almost £2,200. Now, I know that £1,000 a month is too much for most of our budgets, but it's strange to see how we could potentially justify the same purchase of the same car, but if we just kick the majority of the financial burden down the road and deal with it later, but end up paying more in the long run. The car finance industry wants large optional final payments. This is because they know 70% of the time, when faced with the choice of paying thousands of pounds up front to buy the car that you've been driving for the last 3 years, or paying a couple of £100 a month to get a brand new car, people are going to choose the brand new car. Now, I've said this in the past, I don't think that debt is a problem. In fact, in the right circumstances, it can provide a massive boost to your buying power and give you the financial edge. This isn't one of those times though, and the reason is my next point. Debt costs money, that's the issue, plain and simple. There's a big difference between the rich and the poor, and it is one of the big reasons why the gap between the rich and the poor expands and grows every year. It's the fact that the rich earn interest and the poor pay interest. Every debt has an interest rate, and most of them will be above 2%. If your debt is above 2%, you are losing money over time. And if what you've bought with your debt doesn't make money or pay for itself, or is reducing in value over time, then you are sacrificing your future income, leaving yourself with less money to spend in the future. Being on a car finance agreement is exactly what the dealer and the finance company want, and it's for exactly that reason that I'm paying my money to get off the car finance treadmill now. There's nothing wrong with having a finance agreement as long as you make sure that you adapt it to suit your circumstances and your needs. Agreements are very flexible. You can change anything within them except for potentially the price of the car and, well, the interest rate. Everything else is up for grabs. You can change the contract length, you can change your deposit, you can change your final balance that you have to pay off at the end of the contract. Everything is adaptable, so make sure you adapt it to perfectly suit your needs. And if you're already in a finance agreement, you can probably change your terms during the contract, although they may charge you for this pleasure, so make sure that any potential savings aren't outweighed by the cost of actually making the changes. They'll probably call it an admin fee or a restructuring fee or something like that. While it might sound obvious, I've come to realise that the more of my wages I'm able to keep after my fixed monthly outgoings, the quicker and the easier it will be for me to build wealth and live with financial independence by the age of 40. Now, at the moment, my current fixed outgoings are about £788 a month, and I'm able to save about £800 a month. Once my car finance plan ends, my total fixed outgoings each month will be about £659 a month, and I'll be able to save close to £1,000 each month. For me, this is going to make a huge difference because it means more of my money is making interest each month. It's going to compound on itself over time, and it's going to multiply my hard work so that I achieve my goal faster. Now, as I explained before, I have one of the cheapest finance agreements possible for a new car, coming in at just £128 per month. I know many people who spend £200, £300, even £400 or more on their finance agreement alone. And this may work great for them because I know people who change cars with every season, and some people who are only spending 5% of their total income on their finance agreement each year. For them, this may work. However, for many, the convenience of finance is coming at an increasingly expensive cost in the long term. Depending on your circumstances, some of the solutions that you could use to reduce the financial drain on your income from a finance agreement are increasing the monthly payment so that you can either reduce the final balloon payment or reduce the contract length. If, depending on your interest rate, a bank offers a better interest rate, you can use that bank or building society loan or credit card to pay off your secured debt so that the car becomes 100% yours, and then pay off the card or loan as fast as you can. Or 3, you can downgrade. Do the old switcheroo for a car that's £5,000 to £10,000 cheaper than the one you currently have, but keep paying the same amount per month. This will make a huge difference in your final balloon payment or the contract length. It's important to remember one of the keys to building lasting wealth is using interest in your favour, as it helps you build wealth faster. However, it's as effective working against you as it is working for you. I hope today's video didn't leave you feeling tired and exhausted. If you want to get in touch, you can find me on YouTube or on Instagram, and you can ask me any questions about today's video or any other videos, or just have a bit of a chat about money. Until next time, stay cash flow strong, turn your wages into wealth. I'll see you in the next video. All the best. Bye. If you haven't already, subscribe and get notified so that you can see future videos when they come out. And if you want to go back through some of my old work, here's a playlist that I've linked for your pleasure. Have a lovely day. Bye.